on today, and it's time to bring in our guest. This is Thomas Hayes. He is the chairman and managing member of Great Hill Capital. Thomas, welcome to the Open.
Thanks for having me, Corey. Great to be with you.
I'm happy to have you. And Tom, I want to actually kick it off with what's going on in the midterm elections, which obviously is not over. Lots of states still counting, especially in terms of who's going to control Congress. But it's shifted, right? Democrats expected really to maintain their dominance in the Senate without whatever happens in the state of Georgia. How would, though, this outcome affect markets going forward if the Republicans perhaps do take control of the House?
Yeah, well, this is a very good thing, Corey. I mean, the red wave turned into a red tinkle, and it's surprising to say the least. But as it relates to markets, the most important thing is that we come out with a gridlock outcome. The Democrats will have the Senate. It looks like the Republicans will have the House. And what that means moving forward is the Fed will no longer be putting out two fires, i.e. supply-driven inflation and profligate spending at the same time. So what you're going to see if in fact the Republicans do hold the House, which looks probable at this time, is that any new tax or spending or legislative bills will be blocked and we'll be in a period of gridlock, which the market likes because it leaves business to do what business does best, which is grow and add value to the marketplace. So this is very bullish for the stock market. But leaving aside the outcome, on average in the 12 months following a midterm election, the equity indices are up about 18% after a weak midterm election year, which we certainly had in 2022. So all in all, things are setting up for tailwinds moving forward, not headwinds. And the confirmation of the House will be just one more thing that is positive moving forward for equities.
Tom, I love your optimism. Yeah, we're over the headwinds. Let's get some tailwinds going across the broader economy. Speaking of the broader economy and what you alluded to in terms of, the government not having to fight things on two fronts, the Fed perhaps being able to start to create some sort of monetary easing or quantitative easing. We know that this data coming out tomorrow and Wednesday, we're going to get the producer price index first, followed up by the consumer price index, which we do know it has experienced soft inflation for the month. What do you think we can expect, or should we be aware of for tomorrow's data download from the producer price index?
Yeah, well, Corey, I think the PPI is important. That's usually a leading indicator, but the fact that we saw CPI come in better than expected last week, it's 7.7%, down from 9.1% in July, leads me to believe that we should have a constructive surprise tomorrow. It probably won't be groundbreaking, but it should move things in the right direction. The reason we're seeing futures down this morning a little bit, I think, is because Fed Governor Christopher Waller said on Sunday that we're at a point that we can start thinking of going at a slower pace, but he said we're not softening, so quit paying attention to the pace and start paying attention to the end point. So I think that's very, very important that the Fed sees things moving in the right direction so they have something to hang their hat on. They've got the CPI print, now hopefully the PPI print. They're also going to have the jobs report the first week of December and another CPI print before the December 14th meeting. And that's where we see the dot plot, which gives us some indication of where they see the terminal rate. At the last meeting, they had it at 4.6. With the hawkish talk, the market took it up to 5. Now we're back down somewhere between that. So we do want to see that dot plot, hopefully below 5, so we can kind of know when this tightening is coming to an end. And I think it'll be versus a pause. It'll be they'll tighten and they'll stop, and then they'll wait for some time, and we'll probably keep the Fed funds rate elevated for a meaningful amount of time until inflation really starts to come down to normalized levels.
All right, Tom, I'm going to put you on the spot really quickly. If that dot plot comes in below 5, do we see the Fed hike another 75 basis points in December?
No, that's off the table. I think we're going to see 50 in December, and then, there's an outsized possibility, a small possibility that we could in fact see 25, but that would be a function of a really weak jobs report and a collapsing CPI print. which is not out of the question, because if you look historically at M2 money supply, when it collapses this abruptly, which it has, inflation is always a monetary phenomenon. That first rollover print, like we saw in this past print last week, it tends to really drop abruptly after that, if history is any guide. So we may get lucky and get a really good CPI print the day before the Fed meeting, in which case there's a possibility they could go 25, but I think all bets are on 50 at this point. I think 75 has been removed. They are starting to slow. And then the question is whether we do 50, most likely in December. Do they have to do another 25 thereafter before finally pausing? And I think that's kind of priced in as well. So the key is the direction, and the direction is they're no longer at the emergency level of doing 75 every meeting. That's in the rearview mirror, and that's positive for the economy, and it's positive for stocks.
All right, Tom, I want to quickly shift our attention to Disney, because it's actually having quite a good weekend. We spoke a little bit about tailwinds and headwinds as it related to the broader economy. However, Disney is a company that's facing several headwinds, even though, right, Black Panther, huge opening weekend, $330 million globally, $180 million just in North America. Not to mention, in less than 2 months, they're dropping the second Avatar movie, the sequel, that's going to be releasing. And I'm sure that will be another box office hit. Love to get your thoughts really quickly on Disney for the long term, as the company is currently struggling with profitability, especially across its Disney Plus and streaming platforms.
Okay, Disney for the long term, I think, is one of the biggest no-brainers I've seen in the U.S. markets of late. It's down some 55% off of its highs. This is Disney. This is not some penny stock. When you look 3 years out, more people are going to go to the parks. They're going to have more movies. They're going to have more streaming. If you look at earnings, it's unbelievable. You know, the parks business was up 36% year on year, and the market didn't like that. Why didn't the market like it? Well, their subscriptions for Disney Plus were up 12.1 million, 164 million subs. So what's the problem? The problem is Chapek spending too much money on the streaming. The streaming cost losses doubled, which they're going to cut back, or Chapek's going to get cut back or cut out very, very quickly. And he's gotten the message, because this morning they announced the hiring freeze. They're going to cut back on the streaming costs. They've got these movies coming up. But look, it's Disney. You look 3 to 5 years out, this is a tremendous value at these levels. You buy a little bit, you do what you want. But I'll tell you what we're thinking is you buy a little bit. If it goes down further, you buy some more. And you just ease into it over time, because from a long-term standpoint, Disney has a moat on the parks. They're going to figure out the streaming. They've got the best content in the world. Oh, and by the way, the biggest movie coming out in December, as you referenced earlier. So to say we like Disney is an understatement, but certainly do your own homework.
Tom, I also feel like that was a nod that you might be going to see Avatar in December when it comes out.
I've got an 8 and 10-year-old daughter. I don't think it's my decision.
All right, Tom. Well, thank you so much for coming on the show and sharing your insights. Everyone, once again, this is Tom Hayes. He is the chairman and managing member of Great Hill Capital. Thanks so much, Tom.
My pleasure. Thanks, Corey.
Guys.